So the team at UBS has trimmed its estimate for US GDP in light of recent data. Larry Hatheway is the bank's chief economist. He joins me now. Tell me a little bit more about that adjustment.
Yeah, we actually think the growth will come in probably below expectations, maybe even as low as 1% annualized in the first quarter. Subtractions on the trade side, given what we've seen with energy prices, but also subtractions in terms of less of an inventory build. That itself probably bodes better for the current quarter, where growth is probably going to rebound to something closer to 3.5%.
Investors also watching the FOMC meeting. Ben Bernanke is going to be speaking. Do you think we'll get any clues, any real indication as to when monetary policy might change?
I think the Fed is going to announce that it's going to see through the end of QE2 to June, with the full amount of $600 billion worth of purchases completed on that date, but essentially announce that it's going to adopt a wait-and-see policy to gauge how economic activity unfolds, whether higher energy prices are really slowing the economy or whether consumers can withstand that particular shock. And we're going to have essentially an all options on the table policy from the Fed probably through the end of the summer, after which I think the data will probably compel them to begin a gradual process of tightening.
So what does that mean for the dollar? There is the perception is there in the market that rates will remain low for some time yet?
Well, the dollar's on its back foot right now, losing against commodity currencies, the euro, sterling, even against the yen recently. And part of it is a concern that maybe U.S. growth isn't quite so strong. Partly, though, it reflects this difference in monetary policy between major central banks, ex the BOJ, of course, which are all tightening, whether emerging or developed, and the Fed, which seems to be essentially pausing here without giving a strong commitment about where policy is headed.
How will we see that divergence between the central banks manifest itself on the markets?
Well, the concern, it seems to me, is that the dollar continues to fall. Now, in and of itself, that's probably not a big deal, although it poses some growth risks to strong currency regions, some earnings risks as well in those countries. But I think the real concern would be if a weaker dollar be pushed higher commodity prices that are already very elevated. In that environment, you could get a Fed that's concerned about the adverse growth consequences of higher energy prices, for example, but an ECB concerned about the higher inflation consequences, driving a further wedge between the two monetary policy perceptions. It will be a tricky thing to navigate, and that's one of the things we're watching out for in terms of market risk going ahead.
But the Fed is saying that we won't see a sustained rise in inflation, right?
That's right. The Fed is still looking essentially at ex-food, ex-energy prices at core, ticking a little higher, and they'll probably acknowledge that, but certainly not to the point where it has to respond in terms of tightening policy on inflation grounds alone.
So does that mean you see inflation remaining subdued for some time? Are we going to see a sudden spike in inflation because of rising commodity prices?
It looks to us as though U.S. inflation in particular is going to remain subdued. Commodity prices are, of course, a wild card at the headline level, but the underlying rate of inflation is still very subdued in the U.S. economy.
And tell me more about commodities. You said that it's time to reconsider overweight allocations to energy commodities, right? Why is that?
Yeah, we actually have trimmed back the overweight allocation that we had to energy, a pretty long-standing one, to neutral. It doesn't look as though the unrest in the MENA region is necessarily spilling over to energy producers. And we do think that some of the growth data are going to continue to show some slowing. After all, central banks, as we noted earlier, are tightening policy in a number of countries. Global growth is probably going to moderate a bit, and from that perspective, we see more of a stable outlook for energy prices rather than a sharp pullback or even a further sustained rise.
You alluded to the impact this is having on emerging economies. You know, of course, consumers in those countries and China paying more on food and fuel. Will authorities in China continue raising rates?
It looks as though they still have a couple of rate hikes still to go here. That's partly because inflation is likely to remain above 5%. They want to make sure that deposit rates in the banking system don't turn too negative. More likely, though, are further hikes in reserve requirements given the still strong reserve accumulation of the central bank. So a bit more tightening to go in this cycle before China is done.
But are they running out of ways to bring inflation under control?
Well, inflation in China is mostly about food prices, and the hope, I think, we'll have to see if it's borne out, is that food prices are plateauing. So far, the incoming data from southern China, where we're beginning to see harvest, is hopeful, but in northern China, where the drought persists in wheat, is going to be, I think, the wild card for the rest of this year. Underlying inflation pressures in China, though, are not all that strong, so the need for a strong tightening, a powerful tightening of monetary policy is still not yet in evidence.
Okay, Larry Hatheway of UBS, thanks so much for coming in. Good to see you again.